Hey everybody, welcome to the Early Investor channel. My name is Mark, and in this video, I want to talk to you about how you can make about 50% on your money in 1 year with a lot less risk than you might think. Stay tuned. So what I want to talk to you about in this video is using what I call the covered call ladder. Yes, you use a covered call strategy, but there's also a way that we implement a ladder system throughout the course of the next 12 to 18 months where you can make, like I said, about 50% on your money, and there's not as much risk as you might think. I'm going to show you the different option choices you could select from to make your covered call a lot safer from being assigned, yet you could still make a decent amount of money on it along the way. Now, at the time of this recording, it is July 8th, 2021. So the next available options chain for this particular stock that I chose, Tattooed Chef is the stock that I chose for this one, is August of 2021. Now there's some things about the stock, before we get into the options chain, there's some things about the stock that you need to know. One, you don't want to choose a stock that's more than about 10% of your portfolio size. So let's say that you have a portfolio of $20,000. and you choose a stock that 100 shares of that stock would equal about $2,000. $2,000 is about 10% of your $20,000. The reason we want to do it that way is so we're not putting all of our eggs in one basket. We're not saying, all right, half our portfolio is dedicated to this particular option strategy on this particular stock. Now, if you like the strategy and you like this method, we could seek out 10 different stock ticker symbols that all have about a 10% value of our portfolio and do it along the entire stretch of the portfolio. But we don't want to put it all into one particular thing. If you want to take more risk and do maybe 15 or 20% of your portfolio, that's up to you. But my personal rule of thumb, my recommendation, I'm not a financial advisor in any way, but when I do this for myself, I like to do it with 10% of my portfolio. So let's say we look at Tattooed Chef. First of all, we have to be bullish on the stock. Whatever stock you choose, you have to be bullish. So if you look at Tattooed Chef and you think it's going to tank over the next year and a half, don't pick this stock. I personally think that this is a good stock to choose. So I'm going to look at Tattooed Chef. It's about $20 right now. So 100 shares of Tattooed Chef would be $2,000 for our $20,000 portfolio. If your portfolio is only $10,000, then you want to do the same strategy, but you want to find a stock that's about $10 a share, because you're going to need to buy 100 shares of whatever that stock is to do your covered call, and then we'll set up our ladder process along the way. What we want to do is look at the next available monthly options chart. And in here we see, okay, we have options from 1250 calls that we could sell all the way up to 35. Well, the idea behind this is we want to pick something that's about 20% higher than the current stock price. So we see the current stock price is trading at about 20 bucks. We're going to round it off for the ease of math. $20. Well, 20% of $20 is $4. So we want to find a strike price at or above, not lower than, $24. We just take our 20% of the stock price, we add it to the stock price, 20% of the stock price, add it to the stock price, and then we choose the next available strike price. So we see that, well, $22.50, that's not quite 24. They don't have a 24 available, so the next available stock price, strike price, would be 25. Okay, so keep in mind that when you sell a covered call, you're going to get a premium. That premium in this particular case, we're going to say is $55. We're going to take in $55 for selling our Tattooed Chef covered call at a $25 strike. And what that means is by August of 2021, August 20th of 2021, if the stock price of 1995 has exceeded $25, then we are going to be forced to sell our shares for $25. The reason we choose one so high is because we don't want to get assigned. We don't want to have to sell our shares, but we also don't want to pick a stock price that's way out here, like $35. The chances of that happening in the next month is very slim. But if you look at the premium we're going to get, it's going to be around $10 or $15. So we don't want to do it that way. We want to pick one, like I said, about 20% above the share price. Now, $25 is strike price is going to bring us a $55 credit for the month. And as long as Tattooed Chef is not $25 or higher by August 20th, we get to keep our shares, we get to keep the $55, and then we move on to the next month. Now, the reason I like to call it a ladder is because, let's say, since we're bullish on this stock, we know that the chances are good that this 1995, this $20 stock price we have today, it's probably going to be $22, $23, maybe even $24 by August 20th. So when we get to August 20th, we would pull up the next stock options chain for October. For some reason, they don't have a September options chain. But we go to the next month, whatever it is, and then we find the strike price that's 20% above whatever the current price is at the time. So let's say we get to the new options chain and we find out, well, the price is $25. Say the price was now here. Well, we would have to say $25 plus 20% is $5 more. Well, that's going to be the $30 strike, and that's where we sell it and we get our credit of $65. And then we do this every month for 12 months, 18 months. And if you look at it, let's say for the sake of argument that you maintain an average of $50 strike premium, a $50 premium over the course of the 12 months. Well, that's $600 that you're going to make on your stock. $600 compared to the $2,000 we now have into it is a little less than 30%. But keep in mind that the stock, because we're bullish, we expect it to go up a little bit each month. So that's where the ladder comes in. We have a higher stock price, which gives us a higher strike price, therefore a slightly higher premium that we're collecting. So when all said and done, by the end of the 12 to 18 months, you should have made about 50% on your covered calls. Now that does not even count the appreciation that's going to happen in the stock price itself. Your 100 shares by the end of the 12 to 18 months might be up another 50% in itself. So with all that, you can make between 50 and 100% on your shares in the next 12 to 18 months. And the reason I say it's little risk is because if you do happen to get assigned, you still made the capital gains between the share price and whatever strike price you laid out. You still made that money along the way, and you retain your premiums all the way. If you like this kind of content, please subscribe, hit the bell and notifications icon so you can get future videos that will be similar to things like this. And if you have any questions for me, please go see me in theearlyinvestor.com and we'll have the comments open there.